Businesses are on Facebook, including more than half of the Fortune 500. It's all about going where the customers are.
They don't go on a brand's website every day, but they go on their Facebook page every day.
Christian McMahon heads the Dos Equis beer marketing team.
That level of two-way conversation and engagement with consumers, you don't get in any other medium as well as you get with Facebook.
With over 2,000 employees worldwide and two massive compounds at its Palo Alto headquarters, Mark Zuckerberg's creation has brought him a net worth of over $6 billion. And though Zuckerberg has come a long way from that Harvard dorm room, he still can't escape some of the episodes of his past. In 2010, embarrassing instant messages surfaced, allegedly written by Zuckerberg while he was in college. Referring to the first few thousand Facebook users, if you ever need information about anyone at Harvard, I have over 4,000 emails, pictures, addresses. People just submitted it. I don't know why. They trust me. Dumb. For some, the IMs confirmed their worst suspicions about Zuckerberg's views on user privacy.
Those emails back in college, they stick to you now, whether you like it or not. And
Kara Swisher, a technology columnist for the Wall Street Journal, interviewed a visibly sweating Zuckerberg in what became infamously known as his Richard Nixon moment.
You know, some of the things that people accuse me of are true, some of them aren't. I think a lot of it has been pretty well documented.
Right.
You know, the
Would you like to say which ones are true?
You know, I mean, I think there's I actually don't even know, looking back. You know, the IMs are printed, it's tough for me to tell.
Right.
But I mean, there's Face Mash, right? I mean, there are some IMs that have been printed. There are pranks, there's blogs.
Why was he so uncomfortable?
I think it was some sort of panic attack. The story of Mark Zuckerberg is he's incredibly socially awkward, and he runs the biggest social networking site in the world.
Sometimes people really question whether he has the maturity to be the leader that Facebook needs. He doesn't actually like the public-facing role, which is really part of what he has to learn to like, or else he has to relinquish it to someone else.
There's also the question of whether Facebook fatigue could begin to set in.
You don't want to know all these things about your friends. Like, I'm so glad you bought a bike, but please leave me alone. I don't care. It's like the phone is constantly ringing, and you have to keep picking it up.
Facebook has altered the meaning of friendship, and maybe not necessarily in the best possible way. You might argue that it's kind of degraded the notion of friendship.
But the fact that even some of Zuckerberg's harshest critics can't resist it shows the power of the Facebook obsession. Are all of you on Facebook?
Yes. Yeah.
Why?
It would be the ultimate insult if we couldn't even actually partake in the benefits of the idea that we helped spawn.
We did wait a while to join, 4 years.
It's going to get harder and harder for individuals to say that they don't want to be part of it. It's connected people in all sorts of ways that they could not have anticipated. But we have to wrestle with the harm it produces.
The biggest transition that'll take place in the next couple of years is this move from Facebook just being a destination site to being the technology that powers the social web in general.
This is becoming infrastructure for a lot of the planet. As we do move the internet onto cell phones and Facebook goes with it, Mark Zuckerberg sees a Facebook in the future that's completely unlike the one that you and I operate in today.
The Facebook story is a great example of how if you're building a product that people love, you can make a lot of mistakes.
They're a retail icon, making cheap chic.
Target was smart enough to know that if they didn't differentiate themselves, Walmart would crush them.
Target, Inside the Bullseye, January 13th at 9 Eastern and Pacific on CNBC.
CNBC, first in business worldwide.
The worst financial disaster since the Great Depression. Trillions of dollars have evaporated from 401k accounts that have become the primary retirement vehicle for the majority of American workers.
There clearly has been a raid on these funds by the people of Wall Street, and it's cost the savers and the future retirees a lot of money that would otherwise be in their account, independent of the financial collapse.
Amazingly, we have 16 out of the 44 houses on the street have foreclosed over the last year.
And yours over here?
Mine will be number 17.
Welcome to 60 Minutes on CNBC. I'm Steve Kroft. The so-called Great Recession, sparked by the financial crash of 2008, continues to impact the business practices of Wall Street and the lives of Americans on Main Street. This edition examines the seismic shock of the economic collapse on American families and what many of them believed were their most unshakable investment vehicles, their homes and their 401k retirement savings plans. We begin today with the culture of Wall Street and the role that it played in the crash. If you had to pick someone to write the autopsy report on the Wall Street financial collapse in 2008, you couldn't do any better than Michael Lewis. He is one of the country's preeminent nonfiction writers with a knack for turning complicated, mind-numbing material into fascinating yarns. He wrote his first bestseller, Liar's Poker, about his experiences as a young Wall Street bond trader when he was still in his 20s. Another Lewis bestseller called The Big Short, Inside the Doomsday Machine, was published in March 2010. It explains how some of Wall Street's finest minds managed to destroy $1.75 trillion in wealth in the subprime mortgage markets. Just before the publication of The Big Short, we spent 2 days debriefing Lewis at his home in California.
This was an episode where capitalism was almost destroyed just by the capitalists. And in the most sensational way, they were sort of destroyed by their own folly. What happened? The incentives for people on Wall Street got so screwed up that the people who work there became blinded to their own long-term interests, and because their short-term interests were so overpowering. And so they behaved in ways that were antithetical to their own long-term interests.
Michael Lewis, a one-time wonder boy on Wall Street, is ensconced in this hillside compound in Berkeley, California, which has a main house and 3 cottages. And he is much happier writing about business than actually conducting it. He lives here with his wife, former MTV News correspondent Tabitha Soren, and their 3 children, a 3-year-old son and 2 young daughters who he takes to all of Cal Berkeley's women's basketball games. It's one of the few breaks that Lewis allowed himself over the past 18 months as he dug into the idiocy and negligence that produced the worst financial crisis since the Great Depression.
I'm afraid that our culture will come to the conclusion, because it's always the easy conclusion, that everybody was just a bunch of criminals. I think the story is much more interesting than that. I think it's a story of mass delusion.
Lewis's forte has always been discovering little-known facts and characters that change people's perception about a story. So when he finally sat down at his computer with sacks full of research to write about this calamity, he had no interest in Treasury Secretary Hank Paulson or Ben Bernanke or the CEOs of Wall Street's big investment banks, who he believes had no clue what was going on while it was going on. He wanted to tell this story through the eyes of people who were paying attention and who knew that a financial disaster was inevitable.
But there were a handful of characters who actually had seen it coming and made a fortune off of it. And there were so few of them, and there were so many people who had been on the other side, that I thought that I kind of wondered who they were and why they got themselves into that position.
What they saw.
What they saw. Almost more how they saw.
How many people were there, do you think, in the world that understood what was going on?
Between 10 and 20 investors at most. And this is from a universe of tens of thousands of people who could have conceivably made that bet.
The first one to see that something was seriously amiss in the burgeoning subprime mortgage market was Dr. Michael Berry, a California physician with only one good eye. Uncomfortable dealing with patients, Berry quit medicine and started a hedge fund in Cupertino. Beginning in 2003, he turned to something that no one else in America was doing: reading and analyzing the pools of risky subprime mortgage loans that Wall Street had been buying up and bundling into highly profitable mortgage-backed securities, which they were selling to investors around the world.
I called up the prospectuses and I read the prospectuses and I looked at these pools. I could see the credit standards within these pools deteriorating just quarter to quarter.
How could you tell that?
There was essentially crappier mortgages being put into these pools, and it didn't seem investors seemed to care, and it didn't seem the ratings agencies seemed to care.
Do you think many people read these prospectuses?
I think the lawyers that put them together, to an extent, maybe.
Do you think the executives at the big Wall Street firms who were issuing these bonds had read them or understood them?
I don't think they read them, no. I think that there were probably junior analysts that were given the task of reviewing these documents. However, I think that this was a profit center. It was a profit center. It was something the organization wanted to do.
What you were doing sounds to me like the job that the rating agencies should have been doing.
And there's no way the ratings agencies had anywhere near the manpower to look through all that was being issued.
Yeah, but you're one guy. And you found it.
You would think that even if they just looked at a sample, maybe they would have come to a realization. But
by 2005, Michael Berry had come to the realization that the Wall Street bond market had lost its mind. It was buying up hundreds of millions of dollars in dicey loans to unqualified buyers who were, in Michael Lewis's words, one broken refrigerator away from default. Berry concluded that the subprime market would collapse in 2007.
He notices for the first time that there are pools, there are mortgage bonds supported by pools of loans, and most of the loans are what are called negative amortizing interest-only loans, which means that you, the homeowner and buyer, you borrow the money, and you not only don't have to repay your principal, you don't even have to repay the interest. And if you just don't pay anything, they just add to your loan.
So you can't lose your house.
You can't lose your house, right? In theory, right? And so he figures we've reached the end of the road in the insanity of lending. They're scraping the bottom of the barrel. Now is the time to lay a bet. It's before anybody does.
Berry figured out that these mortgage-backed securities would become worthless if just a small percentage of the dicey loans went bad, and he wanted to bet against the worst of them. He decided that the best way to do it would be to get Wall Street to sell him inexpensive insurance contracts on the securities that would pay off big time if they failed. The contracts were called credit default swaps.
He conceives that they are going to invent on Wall Street credit default swaps on subprime mortgages, essentially insurance contracts on the bonds, before they even do. And he participates in the creation of this instrument. And Michael Berry is the first one in.
Berry assumed a lot of people would figure out what he was up to, but very few did. It took 2 years for the drama to play out, but the subprime mortgage market finally collapsed in 2007, just as he had predicted.
So you made a ton of money?
Made a ton of money. Much more than I ever imagined, I'd ever have.
When we come back, a look at the Wall Street bonus culture and why Michael Lewis thinks it's become unsustainable.
Wall Street is able to dilute itself because it's paid to dilute itself.
When 60 Minutes on CNBC returns in a moment.
Wall Street organized itself so people were paid to see something other than the truth. And that's one of the central messages of the story. You have to be very careful how you incentivize people, because they will respond to the incentives.
And all of the incentives in Wall Street's largely unregulated bond market were geared toward keeping the subprime money machine humming. Wall Street's most influential investment bank convinced the financial products division of insurance giant AIG to join the party, a decision that would destroy the company.
They insured tens of billions of dollars of subprime mortgage loans without even knowing they were doing it. Goldman Sachs persuaded them to insure these piles of loans without them ever investigating what was in the pile. So there's an additional level of incompetence. They didn't even know the mistake they were making.
Over a period of just a few months in 2005, Goldman Sachs got AIG to insure $20 billion worth of subprime mortgage securities that the rating agencies had graded AAA. But in fact, Lewis says, the pools contain some of the worst dreck on the market.
Do you think the big banks like Goldman Sachs played AIG for a patsy?
That's exactly what they did.
Lewis calls the Goldman Sachs AIG deal one of the original sins of the looming financial crisis. Other Wall Street firms were so jealous of the Goldman deal, they got AIG to insure another $30 billion of what turned out to be worthless securities. But Lewis thinks the fiasco had more to do with Wall Street's stupidity than corruption.
They didn't understand these things.
Not well enough. I mean, there's a wonderful little vignette in The Big Short about the leading bond trader, subprime mortgage bond trader at Morgan Stanley, a fellow named Howie Hubler, who manages to lose somewhere between, it's hard to know, but $7 and $12 billion in a matter of 6 or 8 months, more than any single trader has ever lost in the history of Wall Street, and no one knows his name.
According to Lewis, at the end of 2006 and the beginning of 2007, when the commercial bank J.P. Morgan became the first to recognize the danger and fled the subprime market, Hubler was gobbling up $16 billion worth of subprime mortgage bonds that would be worthless in 9 months.
He did not understand the forces at work in his own market, and he is supposed to be the smart guy. I mean, what were the dumb guys doing? So I think that it's really clear that that the firms themselves did not understand the machine they created.
What happened to Howie Hubler?
He's allowed to resign from Morgan Stanley, and he takes with him millions of dollars in back pay, tens of millions of dollars in back pay. That it was all hushed up, basically.
Did most of the people who made these terrible decisions leave with a lot of money?
Yes, they all did. I did not run across a single character who didn't get rich. Anybody above a certain level in all these firms made huge sums of money by any standard. And the people who were, I mean, this is where it gets a little creepy. The people who were most instrumental in building the subprime mortgage machine also happen to be the ones who have the most detailed understanding now of the securities in the rubble. And they're being paid all over again to sort through the mess because they're the experts. That is an age-old trick on Wall Street, just generally speaking. People who create disasters make a lot of money cleaning up the disaster because they're the ones who know about the disaster.
By the fall of 2008, with AIG and all of the big investment banks at some risk of going under, the government stepped in to bail out the very firms that had caused the crisis. A decision was made that AIG was too big to let fail, and that its gambling debts would be paid off 100 cents on the dollar. And the company that benefited the most was Goldman Sachs.
Do you believe it had anything to do with their political connections?
It's hard to know. There's no proof, but it certainly didn't hurt. It certainly didn't hurt that the Secretary of the Treasury was a former Goldman CEO. It certainly didn't hurt that a lot of people at the table were former Goldman employees. It certainly didn't hurt that the air everybody breathed contained the assumption that we can never do anything to harm Goldman Sachs. So, sure, I mean, I can't really see how their political influence didn't have anything to do with it.
Once the government decided the banks were too important to fail, Lewis says the only way to get them back on their feet was to give them money.
I think they assumed that in response for this gift of life that they were giving these Wall Street firms, the people who ran the Wall Street firms would behave responsibly in a way that didn't attract the
Meaning what?
Meaning not pay themselves huge sums of money, but perhaps not even pay themselves anything. Just say thank you and rejigger their compensation systems. Instead, they did not. Instead, they used the market as an excuse for paying themselves. If we don't pay our employees of Goldman Sachs huge sums of money, they're going to leave and go to J.P. Morgan. And the J.P. Morgan people say, well, if we don't pay these special people huge sums of money, they're going to leave and go to Goldman Sachs. And you kind of want to back away from it and say, well, wait a minute. Why are they so valuable in the first place?
Did they deserve all that money?
On Wall Street, the business has become very obviously divorced from productivity, from productive enterprise. So in that sense, no, they don't deserve it. They didn't earn it. What they did was finagle it. They were very good at putting themselves in the middle of large financial transactions that probably shouldn't have happened in the first place and taking out little pieces of it. They generated trillions of dollars of subprime mortgage loans that should never have been made. But the world would be better off if that whole industry had never existed. So that's crazy.
Lewis says the more people learn about what happened, the angrier they become.
What about reform? I mean, do you see anything happening?
There are several things that obviously should be done that have not been done. And you can't explain to my mother why they haven't been done. Only a really smart person on Wall Street can explain why they haven't been done. But, for example, all right, one of the things at the bottom of this crisis, we had these ratings agencies that called a lot of things AAA, gold-plated securities that were worthless. And the ratings agencies are paid, of course, by the Wall Street firms for their ratings. Why is that allowed? Why can you buy a rating? That seems like a very obvious thing to change. And people talk about it, but it hadn't happened. Credit default swaps, insurance contracts that we trade freely, but it's not classified as insurance. This market is the closest thing to sort of ground zero of the recent calamity, and yet nothing has been done to change the market. Nothing's been done to make it more transparent. Nothing's been done to make it more like what it is, an insurance market. That's an obvious reform. From the time I was at Salomon Brothers, it was incredible to me that the firm could advise customers what to buy and sell. At the same time, they are betting on the things that they're trying to sell their customers. So I might call you up and say, wow, these subprime mortgage loans, they look really, really good. This pile over here, you ought to invest in that pile. And meanwhile, the traders behind me are betting against it.
Lewis believes the financial industry is living in a world so disconnected from American life that it can't be sustained. He thinks it may take a while, but he believes that Wall Street, as we know it, has done itself in.
The leaders on Wall Street completely lost any sense of their responsibility to the society. And if you know you're going to blow up AIG by putting $20 billion of bad subprime mortgage risk into it, even though it's going to be very profitable for you, you should stop and say this shouldn't be done.
The Big Short proved to be another big book for Michael Lewis, gaining bestseller status and being named to several lists of the best books of 2010. Dr. Michael Berry, who predicted the collapse of the subprime market, has been a vocal critic of former Fed Chairman Alan Greenspan. In a New York Times op-ed page piece in April of 2010, Berry rejected Greenspan's claim that everybody missed it in regards to forecasting the financial meltdown. Berry wrote that Greenspan, quote, should have seen what was coming and offered a sober, apolitical warning. Everyone would have listened. When he talked about the economy, the whole world hung on every single word, end quote.
Coming up, the housing math of strategic default.
You can afford to stay here, correct?
I could, yeah. It's almost like the in thing to do right now, it seems like.
Walking away when your home is underwater. Next, when 60 Minutes on CNBC returns.
In the wake of the financial crash of 2008, many homeowners across the country saw the value of their property tumble dramatically. This situation created a new housing trend. A growing number of people who could afford to pay their mortgages began walking away when the value of their homes fell below what they had paid for them. It's called strategic default. Homeowners have done the math and decided that making those monthly payments is just throwing money away, leaving the mortgage holders, the banks, as zookeepers of an ever-growing parade of white elephants. As Morley Safer reported in May 2010, more and more Americans who can afford to stay in their homes are simply walking away.
Among them, Chris Diener and his wife Dana of Sun City, Arizona. West Foothill Drive has become a street of shattered dreams.
And amazingly, we have 16 out of the 44 houses on the street have foreclosed over the last year.
And yours over here?
Mine will be number 17.
When Diener, an auditor for a local university, bought his 3-bedroom house in 2006 for $262,000, he thought he got a bargain.
First-time home buyers, we don't know, houses are overvalued. We just know we need to get in before it keeps going up and up and up.
And then?
And then, boom.
The balloon burst. So how much does he think he could get for that $262,000 house today?
Right now, about $142,000.
That's a big drop.
Big drop. Over 43%.
Diener and his house were, as they say, underwater. With a mortgage of about $250,000 on a home worth less than $150,000, he has one very expensive lemon. He says he tried to talk his bank into renegotiating his mortgage, but because he earns enough to keep paying, the bank said no deal.
They refused to. They said it was going to affect my credit and they were going to take my house, and I pretty much said go for it.
But you could afford to stay here, correct?
I could, yeah.
But he chose not to. He's walking away. That lemon of a house is now the bank's problem.
It's almost like the in thing to do right now, it seems like.
And because Diener, like many Americans, only made a 10% down payment on his home, taking a hike is a lot easier. By law in Arizona and 9 other states, the bank cannot go after any of his other assets. But his credit rating will suffer. Aren't you fearful that you're going to get a reputation as being a deadbeat?
Yeah, but with the money savings that I will have in 4 to 6 years, I'm confident I will have enough money to buy my way into a house if I want.
So you don't feel even a twinge of guilt?
No, especially after dealing with my lender, trying to contact them. None at all.
Neither do Jean Ellen Schulich and Danny Kuhn. They bought their Phoenix bungalow 3 years ago for nearly $400,000. The bank now values it at $85,000. Even though they can afford the mortgage payments, they felt they were trying to bail out a notion with a bucket.
No logical business person would do anything other than walk away. And so there was a lot of soul searching, and I did a lot of crying because I'm in love with this house. And every day I would redo the math and think, maybe we missed something. Maybe, this just can't be right.
But it was. The value of their house was dropping anywhere from $5,000 to $8,000 a month. So Schulich and Kuhn just felt it was time to walk away.
I don't think we're villains. We fulfilled the parts of our contract that we have with the bank. We've let them know what we're doing. It's all legal. It's not anything I ever expected I would be doing, and it sure doesn't feel good, but it seems like it's the right thing to do.
What do your neighbors make of it? Another empty house brings down the value of everyone's house.
And we've seen that here. I think they will be upset, and I understand that.
Yeah.
But you're hardly alone in Phoenix right now.
True.
It's interesting the number of my coworkers who have approached me to say, how are you doing this? Because I need to do it.
The Southwest has become an inland ocean of bad mortgage debt. Here in Arizona, a full 50% of houses are underwater. And next door in Nevada, it's even worse. 65% of houses there are drowning and the water's rising. And it's not just the Southwest. More than 11 million homeowners across the country are underwater. It's estimated that number could double in the next year, which means nearly half of all American mortgage holders will owe more on their homes than those homes are currently worth.
We've been through an event that none of us have ever experienced in this country since the Depression.
To try to stem the tide of foreclosures, the Commissioner of the Federal Housing Administration, David Stevens, says the Obama administration has set aside billions to give banks the incentive to help struggling and underwater borrowers with their mortgages. But banks have been slow to modify the terms of those loans.
The fact of the matter is, these programs are designed to affect those who are most at risk, who are unable to make their payments. And it does require the investor, the servicer to participate.
The decision to walk away from the sinking home by people who can't afford to pay is spreading like a virus. Because if one person on the street does it, the next door neighbor says, what am I doing? Why am I putting all this money into this almost worthless house?
The concern has to be, for someone who's going to take that move, is that they have to be so deeply in negative equity that they're willing to damage their credit, damage their financial reputation going forward. If you get foreclosed on in your home, you walk away from your mortgage, when you could have afforded it particularly, that's going to follow that family for years to come.
Coming up, should there be shame in strategic default?
There isn't shame in defaulting. The banks don't feel shame by foreclosing on a person's home.
So you're saying we should all be acting like bankers?
Sure, I mean, it's a business transaction.
Next, when 60 Minutes on CNBC returns.
Response to your online inquiry?
Chad Rule, co-founder of a new business called YouWalkAway.com, says fears of the consequences are overblown.
People think that if they're late on their payment or they defaulted, that a sheriff's going to come the next day and rip them out of the home. What we do is offer people a peace of mind right away that they know that's not going to happen.
I'm going to be here for you throughout the entire time, so you can always call.
The website urges underwater homeowners to unshackle themselves from their mortgage obligations and, for a price, walks them through the process of walking away. Rule says his greatest challenge is convincing people that they are not immoral.
The biggest concern people our customers have, is this stigma of foreclosing and what will the neighbors think. But as more and more people are foreclosing, that stigma is wearing off. People are realizing now that there isn't shame in defaulting. The banks don't feel shame by foreclosing on a person's home.
So you're saying we should all be acting like bankers?
Sure, I mean, it's a business transaction.
Big businesses make such bottom-line decisions all the time. Morgan Stanley walked away from 5 San Francisco office buildings they bought at the height of the boom. And real estate developer Tishman Speyer defaulted on the huge $5.4 billion Stuyvesant Town apartment complex in New York City when its value fell by nearly half, making it one of the biggest walkaways in real estate history. It's a trend the banks fear could catch on with average homeowners. No bank we contacted would talk publicly about strategic defaults, but all indicated they'd be unwilling in most cases to help underwater homeowners who can't afford to keep up their payments. And Commissioner Stevens agrees with the banks.
To simply allow anybody who just decides they don't want their home anymore, who signed a contract to purchase a home, to walk away and get some sort of write-off with a program backed by the administration or a financial institution creates a whole new set of standards that will live with us for years to come. The question is, who pays that bill?
For now, that bill is being paid by people like businessman Tom Hansen of Scottsdale, Arizona. He bought his dream house on Gold Dust Avenue 5 years ago. Much of the gold has evaporated, and he's left with a pile of dust.
I paid $1.2 million for the house.
What's its value today?
$850,000, if you can sell it.
While his friends are urging him to unload that monkey on his back, Hansen just can't bring himself to do it yet.
I just would not be comfortable walking away. And so, maybe at some point in time, I will walk away. But right now, I'm not.
What you're saying is it really comes down to conscience.
I think it does.
I mean, you are attached to the house, correct? I mean, it's
I am. Yeah. I love the house. So I'd have to go find a house that I liked better.
It's an expensive love affair.
Aren't they all?
But the Deaners, who stopped paying their mortgage 5 months ago, plan to stay in their house for free until the bank forecloses in July. Then, with all the money they save, they plan to rent a nicer, cheaper house for a few years while his credit recovers. There are people saying if everybody did what you're doing, the country would be in even bigger, deeper trouble than it is right now.
If that starts happening, that's for the professionals to figure out.
So you don't feel any responsibility for it?
Unfortunately, no, I don't.
In our next story, we look at how the 2008 financial crisis impacted another pillar of American retirement investment, the 401k plan. In the wake of the Wall Street collapse, trillions of dollars evaporated from those accounts, the prime source of retirement funds for a majority of American workers, affecting their psyche and their future. The consequences for many were dire. In April 2009, I reported on the shortcomings of a retirement system that's jeopardized the financial security of tens of millions of people.
It was a gray, chilly morning in Midtown Manhattan, and a line of unemployed, mostly white-collar workers stretched for blocks around the Radisson Hotel. More than 1,000 middle managers, stockbrokers, consultants, secretaries, and receptionists had come here hoping to find a job.
If you are just arriving, please step this way.
Good morning.
It was called a career fair, but there was no merriment here, only a whiff of desperation.
You have any openings in the IT?
Many of these people had been out of work for months and burned through their liquid assets, their future even bleaker than the present. Alan Weir, who turned 60 this month, showed us his latest 401k statement, which he hadn't had the courage to open up.
I'm afraid. You're going to open it now? You want me to? Let's do it.
There's good reason for his trepidation. Nearly half of his life savings have vanished in a matter of months.
It went down again.
How much you down overall?
About $140,000.
You think you'll ever get it back?
I've probably never seen it come back. I was looking to retire probably when I hit 62. I can't do it now. I'll probably be working until I'm at least 70.
I'm a Microsoft Office diva.
Until she lost her job, Kathleen Coleman had spent nearly 30 years working as an executive assistant on Wall Street. She doesn't have much to show for it.
Tell me about your 401k.
Does this answer the question?
This is what it was in 2005. 2007, you're down below 2005.
Right. Another one went down almost $40,000. One was 88,000, and then it went down to like 50.
How old are you?
54, and I live alone. I don't have any children. I've been a career girl all my life, and it's been a great career, and I don't deserve this. I'm sorry.
It's all right. Have you had any nibbles?
All the nibbles I've had, I get beat out by top models who can type. And I have experience and dedication and loyalty, and I can make any boss shine. I can. If you're out there, I'll relocate anywhere for you.
What, psychologically, what does this piece of paper do to you?
Oh, it crushes any rest I may get when I'm 65. I'll have to work for the rest of my life.
The saddest part of this story is that it's being repeated all over the country. In eastern Pennsylvania, 59-year-old Iris Hans lost her accounting job and half of her 401k investments. She's now back in the workforce as a part-time cashier in a grocery store.
Your debit card? You have a great day.
In Dearborn, Michigan, Terry and Donna McNally are barely holding on. He lost his sales job in August. The condo they bought 15 years ago is worth less than their mortgage, and 40% of his 401k retirement savings is gone. Donna is the main provider now.
Let me hear you count to 10. Can you count to 10?
1, 2,
running a daycare center out of their home.
6, 7, 8, 9, 10.
Are you here for Joan?
Yes.
Terry considers himself fortunate to have found part-time work greeting the bereaved at a funeral home and making lattes at Starbucks.
It's tough, but I'm proud of him. At his age, to be doing what he's doing.
The 401k drop was tremendous, is tremendous at this point in time, and that's where the savings was. That's our hurt right now.
We can't live our vision of our dream of retirement. That's the worst part. Many people can't.
Coming up, the 401k lobby says the plan is not the problem.
It has let down tens of millions of people at the time they need the money the most.
That's not a 401k problem. That is our entire investment system. This is about the markets went down for everybody. Nobody was saved in the current thunderstorm.
Next, when 60 Minutes on CNBC returns.
On the season premiere of American Greed, desperate times create desperate crimes. A traitor joins the dark side to save his life.
My pride and my ego just destroyed me from the inside out.
Now, in his own words,
I did a wrong thing for the right reason.
some people will do anything for money.
Wall Street trader, bank robber, same thing.
American Greed, Wednesdays. Starts 8 Eastern with an all-new episode at 10 only on CNBC.
Hey guys, printer's out of ink.
Just shake it.
Need ink? This week at Staples, spend $40.
What kind of a retirement plan allows millions of people to lose 30 to 50% of their life savings just as they near retirement? David Ray, president of the profit-sharing 401k Council of America and a lobbyist for the 401k industry, says it's one that empowers people to make their own investment decisions.
401k is the absolute best way people can save for retirement. They absolutely are the best retirement vehicle we have.
How can you say it's the best available if it has let down tens of millions of people at the time they need the money the most?
That's not a 401k problem. That is our entire investment system. This is about the markets went down for everybody. Nobody was saved in the current thunderstorm.
Ray says that many people still have more money in their 401ks than they've actually contributed. He says everyone had multiple investment options, including low-yield guaranteed returns. And he believes people who lost money have no one to blame but themselves.
In America, it's a society based on freedom and choice and personal responsibility. We need to help them understand these responsibilities and execute them to the best they can. 401k is part of that. There are no guarantees.
What about the people who are 63 or 64? A lot of those people were thinking about retiring.
Well,
and now they aren't.
Well, I mean,
a lot of them were retired and have to go back into the workforce.
Well, but that was not a 401k problem. That's an investment system problem. The markets go up and down, and if those people chose to take equity risk, there was a logical outcome.
But in fact, the 401k plans that have become the primary source of retirement income for 60 million Americans were never designed to be retirement plans in the first place. They were created in the late 1970s as a savings plan and tax shelter for ordinary Americans.
The idea was that workers would make voluntary contributions and employers would match a portion of them. The taxes would be deferred until the employee reached the age of 59 and a half. It was supposed to supplement the two traditional income streams for retirees, Social Security and pensions, one leg of a three-legged stool that would support American workers into their golden years. But it didn't turn out that way.
The three-legged stool, if you will, has gone to two legs, and it's wobbly, and it's wobbling, and I'm not sure that it's going to support anything. And that's the scary part, and people are afraid.
Brooks Hamilton has helped design retirement plans for some of the country's largest corporations. He says 401ks turned out to be so much cheaper than funding pensions that many companies decided to freeze their pension plans and replace them with 401ks. The decision created millions of new employee investors for Wall Street and the financial community, and they pounced on the opportunity.
If you go back and track the mutual fund growth in assets, and you track the growth in 401k plans, it looks like a railroad track leading to the sky. They are parallel tracks.
So the big beneficiaries were the mutual funds.
That's right. That's correct.
When employers began turning 401ks into retirement plans, the financial community was not shy about promoting them as such. The prospect of trillions of dollars in the hands of unsophisticated investors opened the door for all sorts of potential abuses.
The fact is that the typical 401k investor is a financial novice. They don't know a stock from a line. And we give them a list of 20 or 30 mutual funds with really, really powerful names. You know, they sound like, gee, that's where I want to have my money.
What are generally the quality of the mutual funds and 401k plans?
Mediocre. I'll be real honest with you. With half the funds on the list, really dogs, what people would characterize as dogs, shouldn't be on the list to start with.
There clearly has been a raid on these funds by the people of Wall Street, and it's cost the savers and the future retirees a lot of money that would otherwise be in their account, independent of the financial collapse.
Representative George Miller of California is chairman of the House Committee on Education and Labor and a staunch critic of the 401k industry, especially its practice of deducting more than a dozen undisclosed fees from its clients' 401k accounts.
Now you got a bunch of economic wizards jumping in and taking money out of your retirement plan, and they don't want to tell you how much. You can't decipher it in simple English, and they're not interested in disclosing it or having any transparency about it.
And most of the people that look at their 401ks have no idea that these fees are being taken out.
No. Where would you find it? Where would you find these fees in this prospectus? You can look on any page you want, and when you're all done reading it, and you will find some of the fees and the commissions here, but you won't find them all, and I bet you won't find half of them.
There are legal fees, trustee fees, transactional fees, stewardship fees, bookkeeping fees, finder's fees, and the list goes on and on. Miller's committee has heard testimony that they can eat up half the income in some 401k plans over a 30-year span, but he has not been able to stop it.
We tried to just put in some disclosure and transparency in these fees, and we felt the full fury of that financial lobbying.
David Ray, a lobbyist for the 401k industry, says he favors disclosing the fees, but his partners in the financial industry don't.
You think most people know these fees exist?
I think they know that there are fees. They don't know exactly how large they are.
Why do you think the financial services industry is opposed to fee transparency?
I don't know that they're opposed to it. I think the issue is...
You don't think they're opposed to it?
Well, they want to keep...
You're a lobbyist in Washington, right? You know they're opposed to it. George Miller hasn't been able to get a bill to the floor.
I think they want to keep the systems as simple and not make changes. They like the way things are, and whenever you push people out of their comfort zones, you know, it's an issue.
I mean, they're comfortable with the situation because they're making a ton of money, or they have made a ton of money.
Well, and their systems are set up in certain ways. You know, this is going to be a big change.
We wanted to ask David Ray, who's been so bullish on 401k plans, one last question about what the future holds for people like Terry and Donna McNally and Kathleen Coleman, who you met at the beginning of this story.
Dedicated, loyal, I can be there, there's nothing standing in my way. Thank you. Need a babysitter?
Most of the people that we've talked to are 50 and 60 years old,
right,
and have sustained these losses, say there is no way they're ever going to make them back.
Right.
Do you agree with that?
I think we have to be truth tellers. I think that when a person has hit this point and we've had this unfortunate situation, I don't think we can misrepresent what the possibilities are.
And the reality is that money's not coming back that they've lost.
They can't count on it. They have to, maybe they have maybe if they work 10 more years, it'll come back by the 10, but it's important that they not have unrealistic expectations.
George Miller lost his House chairmanship as a result of the 2010 elections. Miller, though, remains a staunch critic of the 401k industry and continues his crusade against the hidden fees charged to 401k investors. That's this edition of 60 Minutes on CNBC. I'm Steve Kroft. Thanks for joining us.
More years.
Besides the president, Bernanke is the most powerful man working to fix the economy, and we were surprised by his candor.
Mr. Chairman, I'm going to start with a question that everyone wants me to ask. When does this end?
No one comes in without FDIC badges.
Could your bank be shut down? That's what's happening to this bank and to banks across the country. It's being done in secret by a group of agents led by the FDIC, who move in after closing time when a bank has failed.
It's weird economics when it really comes down to it, isn't it?
Well, from our perspective at the United States Mint, it's unsustainable. You can't sustain losses on pennies and nickels and expect to be a viable organization that benefits the American people.
Welcome to 60 Minutes on CNBC. I'm Leslie Stahl. By most accounts, the financial crash of 2008 pushed the U.S. economy to the brink of collapse. In its aftermath, some of the country's biggest banks received very big bailouts, while large numbers of small local banks failed. This edition features a unique inside look at the seizure of a failed bank and a rare interview with one of the men at the center of the 2008 economic crisis and the recovery plan that has followed, the chairman of the Board of Governors of the Federal Reserve System, Ben Bernanke. Plus, Morley Safer asks, Can America afford the Lincoln penny? Well, we begin with Bernanke. After the crash of '08, Bernanke invoked emergency powers, and with unprecedented aggressiveness, he's thrown more than $1 trillion at the crisis. The words of any Fed chairman cause fortunes to rise and fall. And so by tradition, chairmen of the Fed do not do interviews. That is, until March of 2009, when Ben Bernanke sat down with Scott Pelley.
Mr. Chairman, I'm going to start with a question that everyone wants me to ask. When does this end?
It depends a lot on the financial system. The lesson of history is that you do not get a sustained economic recovery as long as the financial system is in crisis. Now, we've seen some progress in financial markets, absolutely, but until we get that stabilized and working normally, we're not going to see recovery.
I wonder, do you expect double-digit unemployment?
Well, it's hard to forecast exactly where we're going. Unemployment is rising, job losses are still very severe, and no doubt the unemployment rate is going to go higher than it is. But I think, again, that if we do succeed in stabilizing the financial system, that we'll begin to see a slower pace of decline and eventually a stabilization that will set the basis for a recovery.
Ben Bernanke, age 55, has been chairman of the Federal Reserve Board since 2006. For our interview, he opened up the Fed headquarters, rarely seen by the public. It's a monumental building along the National Mall. Construction started in 1935, in the depths of the Great Depression.
You know, Mr. Chairman, I think the Federal Reserve for most people is a mystery.
Well, it's an institution that people don't hear so much about, but it's a very important one. It manages monetary policy for the country. It's one of the main tools we have for stabilizing our economy and keeping prices stable.
When was it founded?
Fed was created by Congress in 1913, and its original purpose was to deal with financial panics, which is what we're doing right now.
Bernanke's crisis started in 2007 with the mortgage meltdown. Lenders began to fail. Bernanke cut interest rates repeatedly. In 2008, the Fed stopped the collapse of Bear Stearns by arranging a sale to another firm. But then came the end of Wall Street as we knew it. Mortgage giants Fannie Mae and Freddie Mac were seized by the government. On September 14th, Merrill Lynch was sold in distress, and the next day, 158-year-old Lehman Brothers failed.
You didn't rescue Lehman Brothers. It set off a worldwide panic when it went bankrupt, and I wonder, looking back, whether you think that was a mistake.
There were many people who said, let him fail, you know, it's not a problem, the markets will take care of it. And I think I knew better than that, and Lehman proved that you cannot let a large internationally active firm fail in the middle of a financial crisis. Now, was it a mistake? It wasn't a mistake for the following reason. We did not have the option. We didn't have the tools. The Federal Reserve cannot put capital into an institution. All we can do is make loans against collateral.
The day after Lehman, Bernanke's Fed did something astounding. It loaned $85 billion to a company that wasn't a bank at all, American International Group, the global insurance giant that was also involved in backing risky mortgage investments. Bernanke says, unlike Lehman, the Fed could make the loan based on good collateral in AIG's portfolio.
There have now been 4 rescues of AIG for about $160 billion. Why is that necessary?
Well, let me just first say that of all the events and all the things we've done in the last 18 months, the single one that makes me the angriest, that gives me the most angst, is the intervention with AIG. Here was a company that made all kinds of unconscionable bets. Then when those bets went wrong, we had a situation where the failure of that company would have brought down the financial system.
You say it makes you angry. What do you mean by that?
It makes me angry. I slammed the phone more than a few times on discussing AIG. It's just absolutely, I understand why the American people are angry. It's absolutely unfair that taxpayer dollars are going to prop up a company that made these terrible bets that was operating out of the sight of regulators, but which we have no choice but to stabilize or else risk enormous impact, not just on the financial system, but on the whole U.S. economy.
By September, Bernanke and former Treasury Secretary Hank Paulson went to Capitol Hill to urge a massive bailout of the banking system.
At that period, I thought we were pretty close to a global financial meltdown.
How much danger was there? How close a call?
It was very close. It was very close. The Congress passed the bill that gave Treasury the right to put capital into the banks in the first week of October. And it was in the second week of October that the crisis reached its peak. And if we had not had those powers, we could have had a much, much worse outcome. So it was a very dangerous situation.
That second week of October, the Dow fell 18%, its worst week in history. In the midst of the crisis, Bernanke had freedom to act immediately. He doesn't need prior permission from Congress or the president. While they debated on Capitol Hill, Bernanke cut interest rates nearly to zero. Then he used Depression-era emergency powers to launch a dozen rescue programs of his own. There was support for money market funds, mortgages, short-term lending to small businesses, and support for auto loans, student loans, and small business loans. Commitments of $1 trillion, doubling the size of the Fed's balance sheet.
Is that tax money that the Fed is spending?
It's not tax money. The banks have accounts with the Fed much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively, and we need to do that because our economy is very weak and inflation is very low. When the economy begins to recover, that'll be the time that we need to unwind those programs, raise interest rates, reduce the money supply, and make sure that we have a recovery that does not involve inflation.
Coming up, Ben Bernanke is doing things with the Federal Reserve that have never been done before.
It's an extraordinary time. This is a chance for me, I think, to talk to America directly.
When 60 Minutes on CNBC returns in a moment.
The Fed issues U.S. currency. That's why it says Federal Reserve note on all the bills in your wallet. This is the Bureau of Engraving and Printing just a few blocks from Bernanke's office. The Fed's mandate from Congress is to put enough money in the system for maximum employment, but not so much that it sets off inflation. The Fed actually pays for itself and returns billions in profits to the Treasury. In a sense, Bernanke has been preparing for this emergency his whole professional life. He got a PhD in economics from MIT. He chaired the economics department at Princeton, and his specialty is the Great Depression. He's among many economists who now believe that it was the Federal Reserve itself that helped turn a recession in 1929 into a global calamity.
They made two mistakes, basically. One was they let the money supply contract very sharply. Prices fell, deflation. So monetary policy was, in fact, very contractionary, very tight during that period. And then the second mistake they made was they let the banks fail. They didn't make any strong effort to prevent the failure of thousands of banks.
Bernanke told us that we were close to a second depression, and he is determined not to let the major banks fail on his watch.
You know, Mr. Chairman, there are so many people outside this building, across this country, who say, to hell with them. They made bad bets. The wages of failure on Wall Street should be failure.
Let me give you an analogy, if I might. If you have a neighbor who smokes in bed, and he's a risk to everybody, and suppose he sets fire to his house, and you might say to yourself, you know, I'm not going to call the fire department. Let his house burn down. It's fine with me. But then, of course, what if your house is made of wood and it's right next door to his house? What if the whole town is made of wood? Well, I think we'd all agree that the right thing to do is put out that fire first and then say what punishment is appropriate, how should we change the fire code, what needs to be done to make sure this doesn't happen in the future, how can we fireproof our houses. That's where we are now. We have a fire going on.
It's still burning.
It's still burning.
Are you committing in this interview that you are not going to let any of these banks fail? That no matter what their balance sheet actually looks like, they are not going to fail?
They're not going to fail. But what we can do, should it be necessary, is try to wind it down in a safe way.
In other words, Bernanke thinks government should stabilize failed financial companies and take them apart slowly.
What are the dangers now? What keeps you up at night?
The biggest risk is that, you know, we don't have the political will, we don't have the commitment to solve this problem, and that we let it just continue, in which case, you know, we can't count on recovery.
The seal of the Federal Reserve is embedded in the floor, just outside the room that changes the fortunes of the world.
Wow. They don't build them like this anymore.
This is where Bernanke meets with his 6 fellow governors of the Federal Reserve, all of them appointed by the President of the United States. Bernanke also chairs the Federal Open Market Committee, which decides interest rates.
When I called and proposed this interview about a year ago, your representative laughed out loud and said the Fed chairman never does an interview. I wonder, why are you doing this?
Well, it's an extraordinary time. It's an extraordinary time. This is a chance for me, I think, to talk to America directly.
And a chance for us to understand where he comes from. Ben Shalom Bernanke grew up in one of the few Jewish families in Dillon, South Carolina, today a town of about 6,000 people. His grandfather, Jonas, immigrated from Eastern Europe, landed at Ellis Island, and came here to start a drugstore.
Our family came here in 1941. My grandfather, Jonas Bernanke, bought this building, made it into the JB Drugs after his initials.
Later, his father and uncle took over the store, which has since become a restaurant.
We're sitting on this corner where your family store was, and I see it's Main Street.
Yes.
People feel like guys like you are tuned into what happens on Wall Street, and you forget places like this.
You know, I come from Main Street. That's my background. And I've never been on Wall Street. And I care about Wall Street for one reason and one reason only, because what happens on Wall Street matters to Main Street. And if we don't have stabilization in the financial markets, if we don't take the steps necessary to make sure that credit is flowing again, then my father couldn't get a loan to build his new store. When I was young, we had just a screen porch over here on the left side. But,
we went to the old neighborhood. The Bernankes left here years ago, and a recent owner couldn't quite make the mortgage, so the economy literally hit home.
When you first heard that your childhood home had gone into foreclosure, what did you think?
Well, I was sorry to hear it, but, you know, in a way I wasn't surprised. Dillon has taken, you know, a pretty big hit in the economic downturn. Unemployment rate's about 14%, and there have been a good number of foreclosures and plant closings and those things, and I think about that.
Numbers were always Bernanke's thing. He taught himself calculus and got an SAT score of 1590 out of 1600. A friend talked him into aiming high for college.
I came home from school one day and there was a phone call for me, and I picked up the phone. They said, "This is the Harvard admissions department. We'd like to let you know that you're accepted in the freshman class." And I said, "Come on, who is this really?" But my parents had their doubts about my leaving and going so far from home. But
no, wait a minute. Your parents weren't thrilled that you were going to Harvard?
No,
I mean, this is a dream come true.
My mother was definitely against it. First of all, she said, "You know, you don't have the clothes. You won't be able to dress properly for Harvard, and it's a long way from here. How are you going to come home on holidays and so on?" So my parents ate into their savings to let me go, which I'm always grateful for. It didn't work that
Bernanke helped pay for college, working construction and working here. The future chairman of the Fed wore a poncho and waited tables at south of the border.
What did you learn about work?
Work is hard. That in order to feed your family and to give your kids opportunities, it's not an easy thing.
Back in the marble confines of the Federal Reserve, Bernanke told us that he understands that many Americans are afraid.
I've been kicking around the country. I spoke to a woman in Ohio who took her son out of college because she got laid off. I spoke to a woman in Nevada who has an advanced stage of cancer, and she was told by her county hospital that they couldn't treat her because a hole had been blown in the state budget. What do you say to those people?
Well, I got into economics because I wanted to make things better for the average person. When I see a job loss number of 650,000, like we saw last month, I know that's not just a number. That's 650,000 lives that have been disrupted, families that have had to move or take children out of school, houses that may be in danger of foreclosure. I know something about what people are going through.
And that makes it all the more outrageous when he hears of financial firms handing out perks and bonuses after they've taken bailout money.
The era of this high living, this is over now, and that they need to be responsible and use the money constructively.
And you would say what to those bankers right now in this interview?
I'd say that their job right now is to find a way to make loans to creditworthy borrowers, to get their banks back on the path of making good loans, safe loans, and to have a reasonable sense of humility based on what's happened in the last 18 months.
Coming up.
How do we prevent this from occurring another time?
Tougher regulation of large firms.
Next, when 60 Minutes on CNBC returns.
The Federal Reserve is the lifeblood of the banking system. Its 12 regional banks are clearinghouses for commercial banks. This is one of the vaults associated with the Reserve Bank in New York. Robots carry cash in the vault that is as big as a football field and 4 stories high. Each pallet loaded with $100 bills is worth $64 million. The Fed has 22,000 employees. It clears your checks and your ATM withdrawals and provides economic forecasts. But one of its most important responsibilities is regulating the nation's biggest banks, to be the watchdog.
You're supposed to keep them out of trouble. So how did all this happen?
Well, a lot of mistakes got made, no question about it. But, this was a much bigger thing than any single firm or any single individual. Over the last dozen years or so, enormous amounts of savings has flowed into the United States and some other industrial countries. That savings has come from China and East Asia. It's come from oil producers, and it has, in the hundreds of billions of dollars, it has come into our financial system. And that would be great if we took that money and invested it wisely and got a high return. But instead, our financial system didn't do a good job. We had a regulatory system that was like a sandcastle on the beach. When you had little small waves just lapping up against the sandcastle, everything looked good. But when you had a big breaker come in, suddenly the system wasn't strong enough to deal with it.
Does the Federal Reserve bear any responsibility for missing what was happening to the banks as it was happening?
Well, like other regulators, we probably could have done more. We've already done put a lot of effort into reviewing our practices and reviewing the bank's practices. We are trying to strengthen our regulation at every point that we can. So I don't want to deny that we certainly could have done a better job and others could have done a better job.
How do we prevent this from occurring another time?
Well, tougher regulation of large firms. It includes having a set of laws that allows us to wind down a large internationally active firm without the adverse impacts on the markets that a disorderly bankruptcy would have. It includes possibly having a systemic regulator, a regulator that has some responsibility to look at the system as a whole.
Your response has been to do what the Fed didn't do in 1929, and that is pour money into the system. But there's an argument made today that that's not what the problem is. The problem isn't that there's too little money in the system. The problem is there's too much fear in the system. That with these companies being propped up by the government, no one on Wall Street can tell who's solvent and who's not, and therefore business does not move.
Well, I absolutely agree that confidence is key. People don't know what's happening, and they're afraid, and they're not sure whether or not the system is going to recover. So how do you get confidence? That's the question. And I think the way to get confidence is to show progress.
But are you seeing any progress? What's going well?
I think all of our efforts so far have produced results. We're buying about $500 billion in mortgages in packaged securities by the GSEs, Fannie Mae and Freddie Mac. And that seems to have brought down mortgage rates significantly. It allows people to refinance, to get out of high-rate mortgages. We're seeing progress in the money market mutual funds and in the business lending area. And I think as those green shoots begin to appear in different markets, and as some confidence begins to come back, that will begin the positive dynamic that brings our economy back.
What will be the first signs of recovery?
One sign would be that a large bank is successful in raising private equity. Right now, all the private money is sitting on the sidelines saying, we don't know what these banks are worth, we don't know that they're stable, and they're not willing to put their money into the banks.
If you had a message for the American people in this interview, what would it be?
Scott, I'd say three things. I'd say, first of all, that the Federal Reserve is here and is going to do everything possible to support this recovery. The second thing I would say is that recovery is not going to happen until the financial markets and the banks are stabilized. And we do have a plan, we have a program for that, but it's going to take some patience, it's going to take some support, and we're going to have to go forward with that. But the third and final thing I'd just like to say to the American people is that I have every confidence that this economy will recover and recover in a strong and sustained way. The American people are among the most productive in the world. We have the best technologies. We have great universities. We have entrepreneurs. I just have every confidence that as we get through this crisis, that our economy will begin to grow again, and it will remain the most powerful and dynamic economy in the world.
Chairman Bernanke is not the only person concerned about the state of the country's financial system. A lot of people are worried about their bank these days. While devastated giants like Citigroup get bailed out again and again and again, many smaller banks are failing. The federal agency that takes over unsound banks is the Federal Deposit Insurance Corporation, the same people who guarantee that depositors won't lose their money. And you don't see the FDIC seizing banks because these takeovers happen secretly at night to make sure that there's no needless panic by depositors. But in February 2009, Scott Pelley was given extraordinary access to one of these operations because the FDIC wants you to see what happens to your money when your bank has failed.
They're going to start at one branch, pull the cash out, take it inside of the bank.
This is a team of FDIC agents preparing to seize a bank outside Chicago.
What we need to do is we need to pull the corporate records.
They've checked into this hotel under a fictitious name, CB and Associates. To prevent a run on the bank, they don't want anyone to know who they are or why they're here.
You all know that this is for the closing of Heritage Community Bank.
Cheryl Bates and Arthur Cook are in charge of the operation that has been given the code name Happy. Strange, considering what they're about to do.
Do not discuss outside of this room what is going on, what we're here for.
They're here to seize all 5 branches of Heritage Community Bank, a 40-year-old Illinois bank providing savings, student loans, mortgages, and checking. But like so many others recently, Heritage made ruinous bets on real estate. Sheila Bair is chairman of the FDIC.
I wonder if you have a number in mind of how much the FDIC is prepared to pay for bank failures in 2009.
Well, we make a 5-year projection that for the next 5 years we project that we'll lose $65 billion on bank closings.
$65 billion?
$65 billion.
Some of that was about to be spent on the imminent failure of Heritage Community Bank. It held 12,000 deposits totaling more than $200 million. The FDIC team waited for the last customer to leave. Cheryl Bates prepared to go in.
What sorts of specialists do you have on this team?
We have accountants. We have asset specialists who specialize in loans. We have people who specialize in just the physical facilities. And we have a group of investigators that come in and do a review on the reasons for the bank failure.
Really, your whole team could come in and run the bank?
Yes.
Coming up, Operation Happy goes into effect.
We're getting the bank personnel assigned with their FDIC counterparts, and then we have an investigations group that comes in and does a review of the bank.
The seizure of Heritage Community Bank next, when 60 Minutes on CNBC returns.
In October 2008, the FDIC and the state of Illinois ordered the bank to stop risky lending and raise cash, but Heritage couldn't find new investors. The night of February 27th, no one at the bank knew that the end was minutes away. The FDIC walked into all 5 branches at once. The chief executive, John Saphir, was told that the bank that was his life's work was no longer his. We waited outside as they delivered the news to the employees.
With Heritage Bank, your pay stopped at 6 p.m. At 6:01, you went on a pay which is paid by the FDIC. Unused vacation time, you will be paid for it. You will not lose it.
In that moment, Operation Happy looked pretty grim.
When we walk in, we appear to be the bad guys.
I mean, some of those people have been there more than 20 years.
And those are the ones who take it the hardest because they feel that they have put their life into it and now it's no longer there.
Make sure that no one comes in without FDIC badges.
The employees now work for the FDIC. A public notice went up, and that was the signal to a team of nearly 80 people to take over the bank. They took control of the bank website and added a notice that all deposits were safe. Then they started an inventory of all the assets and liabilities.
What's happening right now?
We're getting the bank personnel assigned with their FDIC counterparts. The accounting people are meeting with our accounting managers, and then we have an investigations group that comes in and does a review of the bank.
They broke the news to the media and prepared to reopen the bank Saturday morning, as usual.
What do you expect from the customers?
I think the customers some of them will come in with a sense of fear.
Fear created the FDIC in 1933 after the Depression set off panics that wiped out even healthy banks.
We've been around for 75 years. Nobody's ever lost a penny of insured deposits.
No depositor has ever lost a penny since the FDIC went into business.
That's right, of insured deposits. That's absolutely right, which is why you need to make sure you're below the insured deposit limits. But no one's ever lost a penny.
And the insured deposit limit is what?
Right now it's $250,000. That's the base limit.
At what point is the FDIC broke?
The FDIC is backed by the full faith and credit of the United States government. So if we need to, we try not to and don't want to, but if we need to, we can borrow from Treasury to make up for any shortfall.
So the FDIC never goes broke?
We don't go broke. No, we are the government. We're backed by the full faith and credit of the United States government.
Many depositors were worried when the bank reopened on Saturday.
Morning.
The FDIC's Ricky McCullough stood at the door.
The people who were coming in this morning, what were they asking you?
Can I still write checks? Can I access my safe deposit box? Can I use my ATM machine?
And to all of those questions, you answered what?
Yes.
Customer Bill Hess showed up on a mission with an empty briefcase. He intended to leave with all of his money.
We'd be glad to answer any questions for you.
I don't care anymore. He said, I don't care anymore.
And so I became a little concerned. So I came inside. And one of the things that he told me as he opened up his briefcase, he said, well, I don't have a gun in here. So I said, well, that's good.
McCullough explained to Hess and his wife Audrey that their savings were safe.
So if you have a single account, that's $250. If you have a single account, that's $250. So now that's $500.
Hess's briefcase was empty when he came in and empty when he came out.
We just thought we were going to see closed and the doors locked.
Yeah.
You know.
So how do you feel now that you've talked to them?
It's fine.
Assured.
Yeah.
Assured, yes.
You feel
fine.
assured?
Yes, yes.
You had confidence in the FDIC.
Right.
Yeah. Now, if they can't pay you, then I won't have confidence in them either.
There are 3 ways the FDIC takes over a bank. It can close it and pay off depositors, run the bank itself, or more often, it'll try to find a buyer.
We do have bids from 5 different parties.
A few days before the takeover of Heritage Community Bank, we were at the FDIC office in Dallas, where they were holding a secret online auction in hopes of finding a buyer for Heritage.
I wanted to congratulate you. We've chosen to accept one of your 3 bids.
The winner was MB Financial, a $9 billion Chicago bank. The night of the takeover, all of Heritage Community's branches became MB banks. Mitchell Feiger is MB's CEO.
It's almost as if nothing had happened.
Almost nothing did happen. It's the same products, it's the same services, it's the same people taking care of the same customers.
It was a sweet deal for Feiger. The FDIC paid MB Financial $3.5 million. MB got all of the deposits, customers, and loans. If some of those loans go bad in the future, the FDIC will pick up at least 80% of the losses. We wondered what Feiger thinks of the health of banking today.
You have to believe that dozens and dozens and dozens of more banks have to fail. But it's okay.
What do you mean it's okay?
It's okay because I think the process is smooth. Depositors are fully protected by an industry-funded FDIC insurance. And I think that taking out the weak players and taking some capacity out of the industry is good. It's good for the industry. It's good for the survivors. It will produce, at the end, a much healthier banking system.
If you can put Heritage Community Bank out of its misery, why can't you do the same with Citigroup?
First of all, I don't talk about open and operating institutions. We can only deal with the resolution of a bank, a federally chartered or state chartered depository institution. And these very large institutions that are creating the headlines now, these are really very large financial organizations. So it's more than a bank. It's a broker-dealer. It's offshore operations. It's foreign deposits.
We notice that while giant banks get bailed out, investors in failed community banks like Heritage get wiped out.
Ben Bernanke, the chairman of the Federal Reserve, says that the system is unfair for smaller banks, and that's just the way it is.
Well, I think that's true. And going forward, I think we need to really review the size of these institutions and whether we should do something about that.
Baer surprised us when she suggested that maybe the mega banks, those bailed out by the taxpayers, shouldn't be allowed to exist in the future.
Well, you know, I think taxpayers rightfully should ask that if an institution has become so large that there is no alternative except for the taxpayers to provide support, should we allow so many institutions to exceed that kind of threshold?
And the idea would be that no bank would grow so large that it posed a systemic risk to the economy. That'd be a very different world.
It would be a different world.
Because Heritage Community Bank was bought by MB Financial, the FDIC didn't have to pay depositors. Even accounts over the insurance limit were safe. For Cheryl Bates, it was her fourth closing this year, but certainly not her last.
What do you want people to think when you tell them you're from the FDIC?
I always want them to think that I'm one of the good guys, and that we want to make sure that they get their money back should their bank fail, that they are going to be okay because the FDIC is there.
On October 19, 2010, the FDIC reported that bank failures would cost the Deposit Insurance Fund $52 billion from 2010 through 2014. In November 2010, the FDIC filed suit against former CEO John Saffer and 10 other executives of the failed Heritage Community Bank. The FDIC alleged that the executives were negligent in their management of the bank's commercial real estate program, which ultimately contributed to its collapse. In a statement, lawyers for the defendants said the lawsuit lacked merit. Coming up, does it make sense to keep making the 1-cent coin?
It's unsustainable. You can't sustain losses on pennies and nickels and expect to be a viable organization that benefits the American people.
Next, when 60 Minutes on CNBC returns. Should we make sense? Now, before you answer that, we're talking about those insignificant 1-cent pieces in your pocket or purse. It may or may not come as a surprise that it costs the U.S. Mint almost 2 cents to make 1 penny and almost a dime to make a nickel. If the economy of that eludes you, join the club. Even in Washington, where they literally have the right to print money, as Morley Safer reported in February 2008, there's an ongoing debate over whether it's worth the trouble to keep making sense.
Every year, the U.S. Mint turns out 8 billion shiny new pennies using high-tech presses that operate faster than the eye can see, stamping out Abe Lincoln on blank pieces of metal.
They're making 12 pennies per second. We're making a couple million pennies a day.
And, says U.S. Mint Director Edmund Moy, despite inflation, despite their lowly status, 8 billion pennies still add up to
$80 million. That's real money.
Trouble is, to get 80 million in pennies, the government spends $134 million. And to produce 1.3 billion nickels costs $124 million, even though the coins are worth